Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, young Marc.
Good morning.
Right, so let's put our public transport woes to one side. Let's talk about something much more interesting, the US survey. 3 thought-provoking slides, as always.
Yes.
Let's go straight off to the first one. The headline, Fed rate hikes probabilities.
Yes, nothing much has changed here. We probably just priced out a little bit June rate hike, but I think everyone's still assuming they go in June, and there was certainly a very strong suggestion in the FOMC minutes that they would. However, there is a little bit of a sea change here. I think I've sort of mentioned this before, but the market's been debating, is it going to be 3 or is it going to be 4 this year?
Yep.
And kicking already off with Mrs. Mester from the Cleveland Fed yesterday, who is one of the arch hawks, who is basically saying, well, we could go either way. We might not be as aggressive, or we could be more aggressive, depending on how things pan out. But what we've got ourselves in terms of situation with the Fed is actually the markets having been great doubters of, oh yes, but if the S&P drops 250 points, then the Fed will back away. Has probably got everything priced in, and the risks with the Fed now are as much on the downside, i.e. they do less, rather than they do more.
On the upside, okay.
The complicated bit about for markets is the FOMC minutes gave a very strong hint, which I have to say I wasn't particularly surprised by, but because it's been flagged up by the likes of Mr. Williams, who's going to be the New York Fed president, and therefore probably the most important person in terms of the committee, that they are probably going to drop the dot plot because apart from anything else, they all hate it. They feel like they're shackled to it.
Under too much pressure, effectively.
Well, to a certain extent, they just feel markets are too obsessed by it.
Yep.
So we're in a situation now, actually, in interpretive terms, where do the risks lie with US rates? And the answer is actually they might not be as aggressive as markets assume they are. I think it's still right that the markets are pricing in 3 rate hikes this year, but there is a certain risk, particularly if we have a setback in asset prices, i.e. the S&P 500, which seems improbable at the moment, given the news this week that we've had, that we're looking at corporate QE, as I think is the best way, i.e. share buybacks, of in the region of $1 trillion, which is a number which is rather difficult to deal with. Why should share prices come back? And the answer is, well, I can't see any particularly good reason. Nevertheless, if we move on from the Fed, there are people talking about how badly, and I stress in inverted commas, corporate bond markets have done this year. So I thought, well, yeah, here's a simple thing. Let's compare what's happened with US 10-year yields, which is that yellow line, and investment grade, i.e. top-notch, corporate bond spreads this year. And this really bad year for investment-grade corporate bonds, it is a poor performance relative to what we've seen in the last 10 years, true. But what's it a function of? Is it the fact that we're actually anxious about corporate credit or not? Or is it just a function of the fact that we've seen a big rise in US Treasury yields? And the answer is, we've just seen a big rise in corporate Treasury yields. And if we move on to the so-called risky sector, when I was looking at that, well, actually high-yield bond spreads, yeah, they're about mid-range for what we've seen over the last 6 months, but they're certainly not even at the levels that we were in early January, rather in early February. And do they signal that there is concern that with rising US Treasury yields and with rising US rates, there's going to be a problem for the corporate bond sector? I don't think so. So we're in a situation where we're sort of moving through Q2. markets actually, for choice, after the excitement of early February, are quite dull. But I sense that we're in a little bit of danger of misinterpreting things. Just take one small example. Yesterday, we had the US manufacturing PMI.
Yep.
It came in at 56.6.
Okay. Good
Fine.
number.
Yeah, good number. Everyone said it was a good number. The German manufacturing PMI came in at 56.8. Yes, the services PMI fell quite sharply. But the German number apparently was bad. But it was better than the US one, which was good. And what I'm worried about here, when I'm talking about, say, those corporate bond spreads, is we get into a narrative of misinterpretation in markets, and that's actually where the biggest risk lies for markets, that we focus narrowly on a specific aspect. Yeah, okay, so the German manufacturing PMI is down quite a lot from where it was this time last year, but 56.8 isn't weak.
Still
Yes, and that is the perspective thing, and if we lose perspective on where things are in actual terms as opposed to in relative terms, we are in danger of actually making some asset misallocation.
On that note, young Mark, thank you very much indeed.